Have you ever wondered about the powerful tools available in financial markets for managing risk and capturing opportunities, especially when it comes to gaining exposure to assets you might not yet own? The fundamental difference in underlying asset exposure between futures and options lies in their obligation versus right structure. Futures contracts involve a binding obligation for both parties to buy or sell an asset at a predetermined price and future date, providing direct, full notional exposure. In contrast, options contracts grant the holder a right, but not an obligation, to buy or sell an asset, meaning their exposure is limited to the premium paid or potentially much larger for sellers. This crucial distinction stems from their inherent design and risk profiles. A futures contract is a forward-looking agreement to transact, requiring both the long and short positions to honor the deal, leading to immediate and continuous exposure to price fluctuations of the underlying asset. This means changes in the asset's price directly impact the profit or loss on the futures contract, often amplified by leverage through margin requirements. Options, however, function as a form of insurance or speculation, where the buyer pays a premium for the flexibility to exercise the right only if it is profitable, limiting their downside to the premium paid. To practically understand this, consider futures as a highly leveraged and direct bet on the underlying asset's price movement. If you are long a futures contract, you benefit dollar for dollar from its price increase but suffer equally from its decrease. Options, on the other hand, allow for a more nuanced approach. Buying a call option, for example, gives you upside exposure with limited risk, while selling a call option offers premium income but potentially unlimited downside if the asset price rises significantly. This difference impacts how you manage capital, calculate potential returns, and assess your overall market risk. Understanding these contrasting exposures is vital for mastering derivative strategies. Futures are typically used for hedging or directional speculation, offering highly efficient full price exposure to an asset class like commodities or indices. Options provide a versatile toolkit for expressing views on volatility, managing existing portfolio risk, or creating complex payout structures, all while offering limited upfront capital risk for the buyer. This includes strategies like covered calls to generate income or protective puts to safeguard against downside. Ultimately, the choice between futures and options boils down to your investment objective, risk tolerance, and the specific exposure you seek. Futures offer straightforward, leveraged exposure with an obligation to perform, making them suitable for direct price participation and hedging large positions. Options provide flexible, non-obligatory exposure with predefined risk for buyers, allowing for more intricate strategies that can exploit volatility or manage risk with greater precision. Both are powerful, but their differing approaches to underlying asset exposure demand careful consideration for effective portfolio management.